Our next presentation is going to be on GASB Updates, and we will have two presenters for this one. Craig Witmer is a member of the firm in our Chambersburg office. He joined SEK in 1999. He has 27 years of experience, graduated from Shippensburg University with a bachelor's in accounting, member in charge of approximately 75 governmental audits each year, and he earned his Certified Governmental Financial Manager designation and AICPA Advanced Single Audit certification. Our other presenter is Teena Curnow. She is a manager in our York office. She joined SEK in 2004, has more than 20 years of experience, graduated from Bloomsburg University with a bachelor's in business administration, and oversees over 25 governmental audits throughout the year. And I will let you two take it away.
All right. Good morning, everyone, and thanks again for joining our webinar. Our part of the presentation, of course, is to go over the latest and greatest from GASB, the national board that sets accounting standards. And this is certainly relevant for anybody who issues GAAP basis financial statements that apply all of those rules. So I'm going to talk about GASB 103 for financial reporting model improvements. And Teena's going to come back on and talk about GASB 104 and 105 for capital assets and subsequent events. So the first thing I want to mention here for GASB 103 is this is effective essentially now for fiscal years beginning after June 15th, 2025. So for your June 30, 2026s and moving forward, this standard will be effective. When this standard first came out, it really kind of seemed like it was going to be a significant change to GASB 34, and that's been around for quite a while. Some of you may be familiar with that, the change to the reporting model that we have now. It kind of morphed over time, and I would say it's a refresh of certain areas, and we'll talk through those. The first thing that I want to mention here is the changes that really were not made. This standard has really been in the works for a number of years. I can remember giving a presentation 7 years ago or so, and one of the things that was initially talked about was changing the concept of modified accrual accounting for governmental funds. And if you issue those GAAP basis financial statements, that's certainly something that you're likely familiar with for your governmental funds, such as the general fund, capital reserve fund. So we're going to change that and really change a lot of the revenue recognition. Ultimately, that got pulled out of the standard. I think that, COVID happened, things got delayed, and they wanted to pare the standard down a little bit. So that got pulled out of the standard and made this a lot less complex than what it looked like it was going to be. However, I will mention that those changes that they're working on or thought about for revenue recognition, changes to the modified accrual accounting, that's still kind of in the works and nothing definitive, but I do expect us to see some changes at that at some point in the not too distant future. So what has changed here with GASB 103? Well, the first thing, and probably one of the most significant elements here, is the management's discussion and analysis. And I know for those who prepare it, it's your favorite part of preparing the financial statements, and I say that with a little tongue in cheek. But it is a significant component of the financials and is something that we as auditors, if your auditors are preparing your financial statements, that we cannot prepare from an independent standpoint. So there are changes here, and we're going to talk through those. A few other changes, not as significant, but unusual and infrequent items are replacing extraordinary and special items. Changes to proprietary funds for the presentation of essentially the income statement and classifying certain types of revenues. Major component units, if you have any component units, some changes to that presentation. Budgetary comparison information, some changes there. And then a little bit of a tweak to statistical schedules if you file an ACFR or accumulated comprehensive financial report. So now we'll focus on the MD&A. And this first table really kind of shows you the current makeup and the components of the MD&A compared to GASB 103. I'm not going to read down through the slide with every component there, but to mention a few things, it is a little bit consolidated, some new sections or sort of retitling of some sections, and then some things that actually are moving out, specifically with budgetary variations and descriptions of that. That's really moving out to another section of the financial statements, and we'll talk about that a little bit later. So aside from just shifting some things around in the order of where things presented, on the next slide, we'll talk about some things here that are really changing with the MD&A. And the first thing here is really what GASB wants to see in the MD&As is more analysis. It was really the intent from the beginning, but they are putting much more of a focus on this. And I've talked about this before in presentations, but the MD&A is really meant to explain the why things happen. The rest of the financial statements really focus on what happened, really kind of looking at historical information. Footnotes, again, just very specific information describing what happened. But the MD&A should be providing additional analysis. What we've seen with many MD&As over the years is it's become kind of boilerplate, where the tables are in there that show the comparisons to prior years, maybe a little bit of information that talks about this went up X percent, this went down X percent, but not a lot of meat around the why those things are happening. And sometimes that's just kind of contained really in the first part of the MD&A with a few bullet points. So this is where you're going to see some significant overhaul of the MD&A, because that analysis really needs to be baked in throughout the MD&A and much more of a focus on that. As we saw in the previous table, there's some things that got combined, some things that got eliminated. A couple other specifics that they threw in here is need to have a discussion of any significant policy changes. And one example that they give is a change in tax rates. If there's a significant policy that's going to have an impact financially, policy change, that needs to be talked about in the MD&A. And then a lot of times there's restrictions, commitments, assignments, those types of things on your equity balances. If that is the case and it has an impact, significant impact on the availability of those resources, that also needs to be discussed within the MD&A. Well, the next slide talks about for the funds, and there's much more of a focus of analysis on the funds. They don't actually require you to have tables, but I want to point out this on the slide. We'll talk about illustrations a little bit. But the funds do, you can put tables in there to show variances for the funds as well. That budgetary information, that is being moved to RSI. And then the other thing to talk about is the clarification of what is included in the description of currently known facts, decisions, and conditions. And just fine-tuning on that a little bit, we have a poll question that's popped up here. So on the next slide, Christine. So this kind of just hones in specifically on what are they expecting to be included within this section. It's been a little bit of open-ended in the past. Sometimes we see some variance as far as what components are included within this section. But some of the things that they talk about that they feel are appropriate for this section. Discussions of economic and demographic changes, if there are significant things happening used to develop next year's budget. If there's a big change in budgetary net position or budgetary fund balance, that can be included in here. Actions that the government has taken related to long-term liabilities or cap assets, that's a pretty common one that you're going to have. Maybe issuance of a debt, a significant project that's coming up, or maybe actions that another party has taken that's going to impact your governmental, such as legislation. That's something that you want to see included there as well. So the next slide just talks about really kind of our end of the MD&A. And if you're familiar with the auditor's report, our reporting on the MD&A doesn't actually impact our audit opinion over the overall financial statements, as this is considered RSI, or required supplementary information. But that doesn't mean that we don't have any reporting responsibilities whatsoever. We do need to read the MD&A, compare it to the standards, not necessarily test it, but compare it to the rest of the financial statements, make sure that it's reasonable. And if for some reason we feel that it's not, then our reporting does change a little bit. And we essentially have to point that out within our auditor's report to say that it is not consistent with GASB standards. So that's something that you certainly want to be cognizant of. And as you review your MD&As, and I think if the way I would put it simply is if you don't make any changes to your MD&A, your audit opinion, could be, or that portion of the opinion could likely be impacted and reported on that way. So we'll shift here from the MD&A and we'll talk about unusual and frequent items. Not no pun intended, but something that you don't necessarily see that often in the financial statements. In the past, these were called extraordinary items or special items. Essentially, changed the classifications to line a little bit more up with FASB, and it's called unusual in nature and frequent in occurrence. And if you read the definitions, kind of what it sounds like: unusual in nature, an event that's abnormal, different from your ordinary activities, doesn't happen that often, from an infrequent occurrence. But this is something significant that has happened. One of the things that they normally point to as an example is, say, a natural disaster, such as a flood that causes a significant impact to the entity. So on the next slide, it talks about if you have those items, there are disclosure requirements. Obviously, you show them separately on the income statement, but you do have disclosure requirements talking about what got impacted within the governmental entity. And I won't walk through it here on the slide, but we have a sample footnote disclosure of what that could look like. And it talks about what happened, the financial impact, revenue that was received from grants, but also expenses as well. So this next piece is, I'd say, sort of the second piece of GASB 103 that's going to require some effort with the reformatting of the income statement. And Christine, if you want to move the slide there. So this is with proprietary funds and operating revenues and on non-operating revenues and expenses. In the past, basically what GASB required was for the entity to come up with of its own definition for operating revenues and disclose that within the financial statements. And that really had a lot of consistency, but sometimes it wasn't necessarily consistent. So now essentially what they've said is we are going to have a very specific definition for non-operating revenues and expenses. And if it doesn't meet that definition, it is operating. So what are non-operating revenues and expenses considered now? Subsidies received and provided, capital and non-capital. And this is probably one of the biggest components of this section. Contributions to permanent and term endowments, revenues and expenses related to financing, such as debt, etc., resources from disposal of capital assets and inventory, and investment income and expenses. Everything else then is shown as operating. A little bit of a carve out here, an exception that they've said, if for some reason one of these activities is typically non-operating, is the principal ongoing operation of the entity, then it would be shown as operating for that entity. So subsidies, on the next slide, this is where we really kind of see some of the nuance here with this change, and probably will change the way your income statement is presented for proprietary funds. So what are subsidies? These are subsidies can be received, obviously, but also subsidies that you may provide to someone else. So somewhat generic here, but you're receiving a subsidy and you're not providing any goods or services to the provider of that subsidy. So of course, grants, come to mind, or a subsidy from the state. But the other caveat here is that this subsidy is directly or indirectly keeping your fees lower. So you're using it in your operations, and it's keeping your fees lower. And it's really the same definition if it's going in or going out, whether you're providing subsidies to someone else or you're receiving subsidies. So, and the other piece here is, as I mentioned, is transfers. Transfers are now essentially considered with subsidies. The significance of that is really, one, the location on the income statement. We'll show that here in a second. But also for your major fund determination, if you're familiar with that calculation that you go through to determine which funds are considered major funds, that calculation now needs tweaked to include the transfers. So how does this impact the presentation within the financial statements? We talked about the subsidies. You have to break those down further between non-capital subsidies, or essentially operating subsidies, and then also capital subsidies. And they show up in separate places within the income statement. So let's move to the next slide, and we'll take a look at the format of the income statement. It's a little bit small here on the slide. Hopefully everyone can see this okay. And this is really just the bottom portion of the income statement for a proprietary fund. But you can see some of the new categories. Of course, let's start with operating income and loss. Then you move into non-capital subsidies for intergovernmental revenue and transfers in. So again, you're defining what is a subsidy and then breaking it down between non-capital or capital. So then below that, you have a subtotal. Below that is all other non-operating revenues and expenses, investment income and interest expense, and then capital contributions or a capital type subsidy. That's where that breakout of those subsidies would be shown. And as you move further down, I won't walk through it in detail, but you can see an example of unusual and infrequent items that's shown on this statement. So really kind of formatting and location, but you will have to look at your accounting for subsidies. You may need to break those down a little bit further within your accounting system between operating and capital or non-capital and capital so that they can be shown appropriately within your income statement. And then quickly here to a small item for within GASB 103 is component unit presentation. In the past, there were some variances in how you can present that. Essentially now you're required to show all the component units within the basic statements. They would go on the government-wide statements, but if for some reason you can't readably show it on those statements, you can show a combining column and have a basic statement, which is a combining schedule for those items. So the next piece is budgetary comparison information. And this is another piece that's going to require some changes and likely some work on your end in preparation of the financial statements. So you may be familiar with which funds need to show a budgetary comparison schedule, and that is the general fund and major special revenue funds. If you happen to show it for other types of funds, that's considered other supplementary information, and these requirements don't apply to those schedules. So what has changed? Well, one, it can no longer be shown as a basic statement on the next slide here. It's no longer shown as a basic statement, so you have no option for that. Occasionally, we saw that with financial statements, not too often, but that's not an option anymore. It must be moved to RSI. And there are some new variance columns that are included. In the past, you just had a variance between the actual and the final budget. You now have to have a variance column between the original and the final budget. But one of the significant changes here is you now have to have notes to the schedule that spell out and explain the significant variances between the original and final budget and the final budget and the actual results. Very similar to the MD&A, that's something that I don't anticipate auditors being able to prepare from an independent standpoint, and really getting that information from our clients if we're assisting them in preparing the financial statements to have a description of what they feel are those significant variances. And they give an illustration of it, which we'll talk about in a sec here, but it's not necessarily paragraphs of detail, more sentences of detail explaining what those differences are. So finally here with GASB 103, I did want to mention the illustrations. A lot of times I don't necessarily point my clients to just here's the standard, but in this case I am giving it to those clients because there's really good illustrations in here, and specifically I'll point to the management's discussion analysis. GASB had not in the past provided a sample of an MD&A, but they have now, and it's not that yours needs to be cut and paste, look exactly like it, but certainly gives you a good format and a guide to follow for what they are looking for. So I will turn things over here to Teena to talk about GASB 104.
All right, thanks, Craig. So the last few minutes here of this presentation, I am going to talk about two other standards that are becoming effective for our government entities, and a little bit of higher level overview of those. We are not expecting these two standards to have as much of an impact as GASB 103 that Craig just reviewed, so we definitely wanted to highlight that more in this presentation than these other two. But still two standards that are going to be effective. You are going to need to be thinking about some things before, during the audit, and before the audit completion, if anything would need to be changed as far as how it's presented, how it's recorded, or how it's disclosed. So here for GASB 104, this is related to capital assets. It's effective for fiscal years beginning after June 15th, 2025. So essentially calendar year 2026 and June 30, 2026 year ends. An overview is essentially the requirements are just having you detail in the capital asset footnote a roll forward that relates to the different classifications of intangible capital assets. And then there's also new required disclosures of capital assets for sale. So part of this standard was trying to consolidate some recently issued standards into existing guidance over capital asset reporting and disclosures. And so if you remember years previous, the lease standard, the subscription standard, it's rolling all of that into here. So formatting wise for those, potentially not a significant change to your financial statements right now, the way they're being reported, because it's not changing how that's being reported. It's really just trying to pull that into this one standard so that everything is in the same place for consistency and clarity purposes. So as far as the intangible asset detail, you must list separately leased assets by their major class, any public-private or public-public partnerships. Normally, we don't see that too often, but they did specifically spell that out. Subscription assets, which would be those IT arrangements for GASB, the GASB standard that was recently issued the past couple years. And then intangible assets, other than those first three, any other right to use assets should not be included with any owned intangible assets you have. So if you have goodwill or anything like that, obviously that would not be part of this intangible disclosure. You would disclose that separately. So what I wanted to talk about mainly for this standard, as far as the potential significant impact that you could have, is if you have capital assets held for sale. So pretty much the rest of discussing about this standard is mainly going to be in this criteria. Capital assets held for sale. What that is you have that if you have decided to sell an asset and it is probable that that sale will be finalized within 1 year of the financial statement date. So what you need to think about there is as far as being sold within the next year, is it currently available for sale? Are you actively seeking a buyer or have a buyer? What the market conditions are for selling the asset. So for example, if you're trying to unload an asset, but it's an obsolete asset, there's not really anyone that likely is able to use that asset. So the likelihood of you selling it is not very probable. That could play into things. And then whether approval is needed. So if you purchase the asset with grant funds, for example, there might be some strings attached to disposing of that or selling that. So that would need to be taken into consideration. And you do need to evaluate this each year. Next slide just has additional information about the capital assets held for sale. You would continue to report those capital assets within whatever category they relate to: land, building, equipment. In your roll forward disclosure, the new requirement is for those assets held for sale, you need to disclose by class the cost, accumulated depreciation, and if there's any carrying value of debt related to pledged, those assets being pledged as collateral. So the next slide shows an example of that. And for footnote disclosure, as of June 30, whatever year end, government has capital assets included in machinery and equipment with historical cost of 1.2 million, accumulated depreciation 132,000. You intend to sell these capital assets within the next fiscal year. They also are pledged as collateral for whatever debt issuance that has a residual liability of $952,000 of principal as of that year end. So that's just a pretty simple example of what you might see needing to be added into your financial statements if you have this situation. The effective fiscal year for this, as I mentioned, calendar year 26, June 30, 2026, you would follow GASB 100, which was issued a couple years ago in relation to the disclosures and any restatements that may need included or explained. If you have comparative statements, obviously there's some extra disclosure involved in that. And if it's not possible to disclose, you need to at least disclose the reason why. The next standard is GASB 105. This relates to subsequent events. So that's already a requirement still. This standard just kind of helps clarify for consistency purposes to get everyone on the same page with what the requirements are for identifying and disclosing subsequent events. So this is similarly effective for fiscal year beginning after June 15, 25. So calendar year 26, June 30, 2026 year ends. Overview just provides guidance on the reporting of these events and just replaces existing guidance as far as how you identify, recognize, and disclose these events. So next few slides, basically just giving a lot more explanation of defining a subsequent event, the criteria for the time period that you need to be thinking about this, and then the results of if you determine you have one. So the purpose of the standard is to clarify the accounting and reporting, the requirements, just explaining what those requirements are. It's basically just highlighting the importance of consistency across government entities. It applies to all state and local government entities, including school districts and utility entities. And getting an understanding of this standard is obviously just going to help you as the client or you as the government entity, and then us as the auditor to have the necessary communications with you to ensure that we are getting the required disclosures in your financial statements. So the objective of the standard is to help identify and evaluate and disclose subsequent events. It covers all events after the financial statement date until the financial statements are ready for issuance. And it covers recognized and non-recognized, meaning disclosure only events. And it just helps promote transparency and comparability because everyone is following this same guidance. So as far as the definition, it is anything that occurs after the financial statement date, but before the financial statements are issued. And the issuance date occurs when the statements are complete and all necessary approvals are obtained. So in our role, that would mean the financial statements are prepped. They've gone through our review process. We've communicated with you, shared a draft of the documents with you. You've reviewed them and have been able to provide any insight as to, in that time period, anything that has occurred. So this is where you come into play from the entity standpoint. Is you need to understand what a subsequent event is, understand any potential policies you have at your entity for identifying and recording and disclosing subsequent events, and then obviously include and retain any necessary documentation around those events, so then that way you can properly evaluate the requirement for disclosing them. For recognized subsequent events, these are essentially definition here. It's a subsequent event that is actually existed at the financial statement date. So examples here, pending litigation, if you had any claims that were open and then subsequently you were able to conclude on those and you had to have a payout so you know what the amount was going to be, so you can then record that liability and disclose the information. Obviously, there's judgment sometimes that are involved in identifying and determining what needs recorded versus just disclosed. But those are kind of some of the things that you would expect to see with a recognized subsequent event. If you go to the next slide, disclosure requirements, regardless, recognized or non-recognized, there's disclosure requirements. So the disclosure, you need to disclose the date of which you have gone through that analysis. That needs to be included in the financial statements. For non-recognized events, you need to disclose the nature and any estimated, if possible, effect of that non-recognized event. And again, it's really just the last two bullet points there are acknowledging to try and include consistency and transparency across all government entities. So anyone who would pick up your financial statements would be able to understand the impact of any possible subsequent event on your activity currently. Implementation wise, we are just recommending that if you haven't already, you look at the standard, you look at policies that you may already have in place for any possible updates that are needed to those. Make sure you're having communications with staff, whether it is those that are involved in your year-end close, your general financial reporting, your legal team, obviously, with any kind of litigation claims you have, working with your auditors to discuss any potential subsequent events you know are going to become something that needs to be evaluated, like if you're looking at issuing debt, something like that. And then obviously the benefits of proper implementation is just making sure your financial statements are accurate and complete, and then consistent with the requirements of the standard. And that's all I had for those last two standards that will be coming effective for you guys.